So once again, good evening and welcome to our today's session. We are finalizing our first topic. We were doing portfolio theory and analysis. It is a very simple concept for those who are able to watch the videos. I know very well that you are able to check on the videos on our YouTube for those who joined us during the week. For those who have joined us today, I will be able to I will just be able to take the videos. I will be able to share the videos with you regarding the introductory parts of the portfolio theory and analysis. But before now we proceed from where we left, it is very important for me to do a recap. And I would like to do a very good concept on a given question where, on a question which we tested on, it should be November 2019, question 3B. November 2019. Question number 3B. November 2019, question 3B. I would like us to check on it so that the new students can be able to see how and what is the concept regarding to the portfolio theory and analysis. Portfolio theory is basically more of investments. Remember, I talked about is more of we are doing our investment in most cases, and there is a risk which is basically involved in our investments. So therefore, it is normally incorporates the aspect of the probabilities, and in other cases, we can be able to discuss of the weights. Remember, we are going to be discussing the aspects of the weights, but because I just wanted us to cover our last, the second last subtopic, so allow me just to start the question straight away. Then I will be able to share the video, the other videos with you for better understanding. So in that case, let me share my past papers. I said, for those who they don't have these past papers, it is very critical for you to download my Loft app, then follow the procedures which are required there. So I'm talking about 2019. I'm talking about 2019, right? November. Let me see whether I have it. It is here. This is a period where we used to have only 2 papers in a year, 2 exams. Because now Celestine is the one who is coming late. She can be able to read for us the question. Question 3B. Celestine can read for us, please.
Question 3B.
Correct.
Duncan Kipchumba has an investment capital of 1 million shillings. He wishes to invest the funds into 2 securities, X and Y, in the following proportion: 200,000 shillings in security X and 800 shillings in security Y. The return on these 2 securities depend on the state of the economy as shown below. So the state of economy is there, probability, return on security X and return on security Y. When the state of economy is boom, probability is 0.4. The return on security is 18% and return on security Y is 24%. When the state of economy is normal, the probability is 0.5. Return on security X is 14%. Return on security Y is 22%. During recession, probability is 0.1. Return on security X is 12%. Return on security Y is 21%. Required: Roman 1, the expected return on the portfolio. Roman 2, the correlations, coefficients between security X and security Y. Roman 3, the portfolio risk. Roman 4, the reduction in risk due to portfolio diversification. And part C of, do I need to read part C of the question?
No, part C is not part of what we are discussing right now.
Okay.
The only areas which we wanted us to cover, you have already read, and thank you for that. Now, you can see we are being given this kind of a question, and it is very critical for you to understand the state of the economy because right now we normally hear our economy discussed about the aspects of booming of our economy, where the economy will be doing very well for each citizen. There is an aspect where we are saying that the certain growth of economy is normal, or we are under recession period. And in this case, you may find that the aspects of analysis is based on the probabilities and the aspects of the GDP. Now, when that comes into place, remember there is investors who are in that country, and therefore they will want to make their investment based on the effects and the increase of the inflation. Today's increase of the salaries, you may find that a certain proportion are being proposed. For example, like what the government or our president was able to propose during the Labor Day. But that proportion, if you can sit down and you analyze that small percentage of increase which he was able to put in place, and compare it with the rate of inflation, then it means that there is no any additional funds in which you're going to be taking home as a part of the increment in terms of the salaries. Since every year you are serving different kind of financial distress. And therefore, it is very critical for you every time you're going to be making analysis of investment, you look at what will be the effect of the inflation in a certain year. And therefore, you will be able to see the proportion which, or the rates which are given in terms of the interest and dividends which are given by these financial institutions. Are they giving you any return of the portfolio? Now, if the question is appearing like this, if the question is appearing like this in an exam, I normally want to teach my students about thinking of having a concept of analyzing the question based on different portfolios which you have already diversified. I know very well that most of you have opened the circles. There are those who are investing on the money markets among other type of investments. If those cases arises, right, it means that there is probabilities which you have taken in place where we normally say hii kampuni haiwezi anguka, right? But things normally happens. Remember one day Chase Bank was able to fall down. Now, if this is the case in an exam, and the examiner is asking you, number one, to calculate what? The expected return of the portfolio. The expected return of the portfolio. I'm just going straight to the question, right? For those who they don't have a questions, they need to go back there. They need to go back and download. We talked about My Loft app, right? Download there to access the past papers. So when you look on the expected return of the portfolio, it's like I'm saying, can I be able to calculate the weighted expected return? The weighted expected return, right? What is it? Is it required here? What is it required here? It is very simple, right? It means we are going just to be taking the summation of return. For example, let's see our securities. We are discussing about X. Then you multiply these with the weights. Let me talk about the weight of X. Plus, now we talk about the weight of Y. We multiply by the summation of return Y. Very simple. Something looking like this, right? Something is looking like that. So in this case, when I'm going to these questions of ours, I'm just going to be analyzing the following aspects. I'm going to be starting. This should be the expected return. Sorry, should be the expected return, not the summations. So nakuja hapo unaniambia mwalimu, to get the expected return of X, we are going to be taking the summation of return of X. We multiply by probabilities. We multiply by the probabilities, right? Now let me start with the expected return of R, expected return of X. And I can be able to see in the question we are being given certain returns there. So the first one, I can see we have 18, and then on the left side, we are being given probabilities. So it will be 18 times 0.40 plus, the other one will be 14 multiplied by 0.50. Then the last one will be 12 multiplied by 0.1. Karaoke should be giving me the answer. The expected return, the expected return, sorry, of y should be equal to what? The summations. Let us take the summation. The first one will be 24 times 0.40 plus the other one will be 22, right? Multiplied by 0.50. Then the last one is 21 times 0.10. I think it should be in or something. I might not be able to capture your name well, but in meantime, I will be able to understand it. Joy, can you be able to give me the expected return of y? How much is it? Then Karaoke is giving me for the x. For the x. How much is it? How much is it? How much is it? I hope you can be able to see everything. And I normally say that I like the participatory class. We are not keeping quiet. We are not keeping quiet. So Joy, how much is for y?
2.27.
2.27.
22.7.
2.7%.
22.
22.7%. Brian, the first one. Brian might not even have a calculator, right? The first one is how much? For those who have already done it, the first one in ngapi? The first one in ngapi?
15.4.
Sorry?
15.4. I'm getting
15.4.
15.4. Yeah.
15.4%. Thank you so much. Now, ukishapata hiyo, unarudi hapa kwa formula yako, unasema I have already gotten the expected return of X. So to get the expected return of the portfolio is very simple. The expected return of X, you have told me, is 15.4. 15.4, right? Then we multiply it by what? What are we going to be multiplying it with here? We talked about the weights. Where are we going to be getting the weights? When I look on the question, which we are analyzing right now, we are being told up there that Duncan Kipchumba has an investment capital of 1 million. He wishes to invest the funds in two scenarios or in two securities, X and Y, in the following proportions. So when you look on to get your weights, for example, the weight of X will be equal to, how much is he investing on the X? He is investing 200,000, right? You divide by 1 million. This one we are getting 0.2. Then we have the weight of Y, where we are taking 800,000. We divide it by 1 million, getting 0.8. Very simple here. So when you are looking on the 15.4, you multiply by the weight of X, which is 0.2. Plus, we are talking about 22.7. We multiply by 0.8. 0.8. Someone to give me the answer. Someone to give me the answer. That is a very simple question. It's a very simple question there. Number two there. We are discussing about correlation coefficient. Someone should have already shouted the answer. Correlation coefficients between security X and Y. What is the answer here? What's your answer? We can go calculator to Maliza syllabus next week. So you don't know how to do that. What is the answer here?
21.24.
21.24. 21.24%. That is the expected return of the portfolio. That is the expected return of the portfolio. Now, number two, we are discussing about correlation coefficient between two securities. We are discussing about security X and Y. And I remember here I said, right? We said that when you are dealing with this kind of question, let us remember the formula to get our covariance. We said, if I wanted to get the covariance of X and Y, we normally take the correlation coefficient between X and Y, we multiply by the standard deviation of X, we multiply by the standard deviation of Y, standard deviations of Y. So if we make the correlation coefficient, here's the correlation coefficient. correlation coefficients. That is our correlation coefficients. If we make it the subject of the formula, it means that to get our correlation coefficient now here of x and y, we are going to be taking what? Covariance of x and y. We divide it by the standard deviation of x. We multiply by standard deviation of y. This is the formula which we have to be using. So in this case, you need to say, when I look on my question, we don't have the standard deviations, and then we don't have the covariances. And that is why I'm taking the question so that the new students can be able to understand this. They can be able to understand this. Let's start with the covariance of x and y. We say, we normally take the return of x minus expected return of x. You close your brackets. You open another bracket, you say the return of y minus expected return of y. Then we multiply by our probabilities. We multiply by our probabilities. This is the formula to get the covariance. I can be able to see we have the expected returns here. We were able to get the expected returns. So to get this question is very simple. This is what we normally do. This is what we normally do. So let me start with the return. The return, even if you check on your past paper, is 18 for x. So it will be 18 minus 15.4, right? You open another bracket to tell me it is 24 for y, minus the expected return of y, which is 22.7. Then you multiply by the first probability of 0.40. Very simple. The other one will be, I can see we are talking about, the next one is 14 minus 15.4. When you open the second one will be 22 minus 22.7. Then we multiply it by 0.50. Then the last one here. The last one will be 12. That side of x minus 15.4, right? Then the other one will be how much? The other one will be 1 minus 22.7. We multiply by 0.10. 0.10. So how much is this? How much is this? For those who have been in class, how much is the first one? For those who have been in class, how much is the first one? How much is the first one? Chunga tusimalize syllabus bila hata wewe kuongea kitu. Chunga usimalize syllabus bila kuongea something. So how much is this? Let me see someone here. We have someone who is called Susan. Susan, good evening. Susan, good evening.
Good evening, sir.
Can you be able to give me the first one? What is the answer for the first one?
The answer for the first one is 1.4.
1.4, correct? Okay. There is another person. Wacha nikiwajua nyinyi wote sitakuwa naangalia. The other one person is Emma. Right? Emma. How much is the second one?
A moment.
Okay. I can see we have Edda. Or is it? Yes. It's called Choge, I think, something like that. How much is the last one? How much is the last one? Nikichukua calculator mimi ningekuwa nishamaliza. So someone to give me the standard deviations here. Wacha niandike the standard deviations. To get the standard deviation of x, we said we normally take the root of the summation of a return x minus the expected return of x squared. Then we multiply by the probabilities. We multiply by the probabilities. We said on the aspect of the absence of the probabilities, we normally use the sample sizes. Our first videos will be guiding you on that. We'll be guiding you on that. So how much is the second one here? How much is the second one? How much is the second one?
0.49.
0.49. Just set this board of ours, which is misbehaving. Someone has told me 0.9.
No, 0.49.
0.49.
Yeah,
Can you say 0.50?
sure.
Okay, the last one. Brian said he doesn't have a calculator. Dorcas, the last one. The last one is how much?
0.6.
0.6. 0.6. How much is the summation? How much is your summation there? Very quickly, let me take my calculator because of time. So it's 1.40 plus 0.50 plus 0.60. We are getting 2.5. 2.50. Now let us come here. When we are discussing about returns, I said when we were in primary or secondary school, we used to talk about when you are getting the standard deviation of a certain security, we used to say x minus x bar squared, then you multiply by the probabilities. But in our case, we're analyzing the returns. So there is no any aspect you're going to be saying my x and y or the x minus the expected bar. So in this case, let me start by analyzing for x. The return of x is 18. So let me just copy this. You can see here, I can just be able to copy this data which is here. So for example, you say it is 18 minus 15.4 squared. Then I multiply by the probability of 0.40, right? The second one will be 14 minus 15.4 squared. Then I multiply by 0.50. Then the third one will be 12. 12 minus 15.4 squared. Then you multiply by 0.10. Someone to give me the summation here. The summation down there. How much is the summation? Very quickly, very quickly. Let me look for the y here. Let us do for y. Very, very simple. For y. For y now, I just copy this data here. So I just say it is 24 minus 22.7 squared. Then I multiply by the probability of 0.40. The second one will be 22 minus 22.7 squared. Then I multiply by 0.40. Then the third one, it should be 5, sorry. The third one now will be 21 minus 22.7 squared. Then I multiply by 0.10. 0.10. Hakuna mtu akona answers hapa. How much is our answers? The first one is hello. The first one is, don't fear to talk. So it is 18 minus 15.4 squared, right? 18 minus 15.4 squared. Then I multiply by 0.40. 0.40. I'm getting how much, Emma?
2.704.
Second one will be 14 minus 15.4 squared. Then I multiply by 0.50, getting 0.98. Then the last one will be 12 minus 15.4. Then we squared, we multiply by 0.1, getting like around 1.16. So the total here will be 2.70 plus 0.98 plus 1.16, getting around 4.84. Now, when you take the root of 4.84, how much are you getting? The root of answer, getting 2.2. 2.2 there. 2.2 is the answer. Now, let us come on the side of y. We say, to get the standard deviation, first allow me to get the variance. So the first one will be 24 minus 22.7 right? Squared, I multiply by 0.40, getting 0.68. The other one will be 22 minus 22.7 squared. I multiply by 0.5, getting 0.25. Then the last one, 21 minus 22.7, right? Then I multiply by 0.1, getting 0.29. So how much is this in total? Unaniambia tu mwalimu, this is very simple. 0.25, then plus 0.68, getting around 1.22. Nakuja hapo unaniambia the root of 1.22 should be equal to 1.1. So get the correlation coefficient of x and y. Nachukua nini? Nachukua the covariance. Uliniambia ni 2.50. 2.50. You divide it by 2.2 times 1.1. How much are you getting there? How much is your answer? So 2.50, I divide it by, you open your brackets. 2.2, you multiply by 1.1. You close your brackets, right? We are getting something like 1. Should be equal to 1. Then we are going now to your previous videos. You remember when we said when you have the positive correlation coefficient, what it means, and when we have the negative correlation coefficient, what it means. Now, from the previous videos, it will be able to guide you about the correlation coefficient and so on and so forth. So allow me now to do the next requirement of the question, because I'm just doing this as a recap for those who are not here. Now, the third one will be the portfolio risk, right? The portfolio risk. Unakuja hapo unaniambia, mwalimu kama wanauliza kitu kama hii, this is the requirement. Kama wanauliza kitu kama hiyo, the portfolio risk. There, right? Number 3. Very simple here. Portfolio risk. Unakuja hapo unaniambia, this one they're asking about the standard deviation of the portfolio. So to get the standard deviation of the portfolio, unakuja hapo unaniambia tunachukua the root of what? Unakuja unaniambia tunachukua the root of, we start with the weights of x squared. We multiply by the variance of x plus the weight of y squared. We multiply by the variance of y, right? Plus 2, the weight of x, weight of y. We multiply by covariance, right? Covariance of x and y. The covariance of x and y. So wakati formula yako inakaa namna hii, unarudi hapa juu unaniambia, mwalimu, we might be having the requirements. Nakuja unachora kitu yako namna hii, and then you follow your formulas. We remember we got some way somewhere. We said the weight of x was 0.2, right? The variance of this umepata mahali 4.84. The weight of y tulipata 0.8, right? Hii kuna mahali ulipata ukaniambia it is 1.22, right? All of these you have. Then you have your covariance of 2.50. Unakuja hapo una feed on your roots. Unakuja unaniambia the first one is 0.2 squared. We multiply by what? What is the variance? 4.84 plus. But when you have the standard deviation, you can root it, correct? Now, the weight of y is how much? The weight of y is 0.8 squared. We multiply by the variance, it is 1.2 for y, plus 2 times the weights. How much is the weight of x? 0.2 times 0.8. We multiply by our covariance, which is 2.50. Which is 2.50. So how much is your answer? Here you are playing with your calculator. Just play with your calculator here. Very simple. Unakuja una take your calculator, you say 0.2 squared. We multiply it by 4.84 plus 0.8 squared. We multiply by 1.22, right? Plus 2 times 0.2 times 0.8 times 2.50. Unapata answer yako, and then you root it. You say the root of answer, getting 1.33. I'm getting 1.33. You are not struggling to get this. These are very simple things. Ukipata hii swali kwa exam, unalala tu. Nalala unasema wacha kwanza nipumzike, kama hizi ndio maswali they are bringing in, wacha nipumzike kidogo. Wacha nipumzike kidogo. Then we have the last requirement of the question. The last requirement of the question. They're asking a very simple question there. They are saying, what is the reduction in the risk due to the portfolio diversification? So when they're asking that, right, when that requirement is put in place, you say, when we say here, sorry, number 4, we say, we normally compare the portfolio risk. We normally compare the portfolio risk. We normally compare the portfolio risk and the weighted standard deviation and the weighted standard deviation to confirm whether we are going to be confirming whether there is a reduction. Whether there is a reduction, we confirm whether there is a reduction in a risk, or in risk of the portfolio. In the risk portfolio. So that is what you normally do. So the moment you shall underline or you shall understand this is what you have to be doing, unakuja hapo unaniambia to get the weighted standard deviation. We normally take the weights of x, we multiply by the standard deviation of x, plus the weight of y, we multiply by the standard deviation of y. Correct? So all these requirements you have. The weight of x, you have 0.2. We multiply by the weight of x, the standard deviation of x is 1.1, plus the weight of y is 0.8. We multiply it by the standard deviation, which is 2.2. Or is it the other way around? What is the weight? Let me check for my answers here. What is the standard deviation of y? 1.1. So here should be 1.1, sorry, it's the other way around. 1.1, this is 2.2. What is the answer? What is the answer? What is the answer? What is the answer there? Mtu hawezi niambia answer ni ngapi? What is the answer?
1.32.
1.32. 1.32. Are you not seeing something? When you compare the standard deviation of the portfolio with the weighted portfolio risk, right? You can see that the difference is just the rounding off. Tukishafanya rounding off vizuri, you are supposed to be getting the equivalent values there. So in this case, under the analysis and understanding, you can be able to say, the portfolio formation, let me just put it here. We say the portfolio formation does not change. The portfolio formation does not change. The portfolio formation does not change the risk. Does not change the risk because the portfolio is positively correlated. Kuna mahali we were able to analyze that aspect. I remember there is an area we were able to check on it, and this is what we said. Right? There is analysis we did in our previous videos. Then I will not be able to repeat it. I'm not going to be repeating it. I just want to share it. So let me just take you you refer to what we discussed about the correlation coefficient and so on and so forth. So allow us now to shift some gears. If you want to do some exercise now, I can just be able to give you, can I give you an assignment? Whether I can have one or we do. There is an assignment here, and it is very good if you can do it. Assignment now. It's very good I give an assignment. Na hii assignment inakuwa inasubmitiwa wapi? In our WhatsApp group. And everyone ajue umekuja peke yako, right? Na exam ni yako. So, wengine they are not doing, wao katai kufanya, kila mtu ako peke yake. Now, that is the assignment. Just go and do it. see if you can be able to try and understand the concepts of the portfolio. But before you do this, go back to the videos and you see if you will be able to understand. You'll be able to understand. If you're not understanding, don't do it. Don't do it. I just want to shift some gears there, and I look at a very simple concept in multi-factor models. In the multi-factor models, we normally, which is just there's normally just a financial model that will be able to employ some multiple factors in each calculations to explain market phenomenon in all the equilibrium assets. So in this case, it basically, when we are reading here, some people may think we are analyzing the something called economics. We are not doing economics. We are just doing financial management, but it normally incorporates some few elements in the topics we have done before, right? So I'm just looking for the areas we can get a very good
I have a question. On which days do we have this class?
Mtu ameuliza swali mzuri pale, anaitwa Eda. Oh, very good. Eda, our classes are normally, we normally do our AFM on Wednesday and Thursday from 8 p.m. Wednesday and Thursday.
Okay, thank you.
Is that okay?
Yes, that's okay.
Thank you very much. Now, I just want to look on the multi-factor models. And multi-factor models is very crucial. You may find it in an exam, whether the one that you will be able to do, right? Or the one which will be able to teach. Hata jinsi mnataka kuwa walimu, wapee kazi. Mkitoa kazi pia mnafunza wengine wakuwe CPAs. Now, we are looking to have multi-factor models, right? Multi-factor models, and I've said this is just a financial. It is a financial model. It is normally a financial model. It's just a financial model that employs. Na ukuwe na kitabu kako unaandika somewhere. Video inaweza potea. That employs multiple factors. That is basically employ the multiple factors in its calculation. Right? In its calculations to explain market phenomena. To explain the market phenomena. To basically explain the market phenomena or equilibrium asset prices. Now, there are three types of multi-factor models. There are three models of multi-factor models. There are three factors, so there are three types. Number one, we normally talk about arbitrage. We normally talk about arbitrage pricing theory. Arbitrage pricing theory. Let me talk about pricing model, right? Number two, we can be able to talk about, number two, we have something called the French model. The French model. Then number three, we normally talk about, number three here. We normally talk about Pastor-Stambo model. We are just having three multi-factor models. The first one is arbitrage pricing or the arbitrage pricing model. And then the second one will be Farmer French. Then the other one is Pastor Stampo model. Now, when you look on the multi-factor models or the arbitrage pricing model, it basically discusses about, it talks about, because it's just a theory which was developed by a guy called Richard Roll and Stephen Ross, right? The arbitrage pricing model, it is just a multi-factor model, unlike a PEM, right? Why are we now factoring the CAPEM here? We are saying, which is a single factor model, right? When you're looking on the arbitrage, it disagrees with the CAPEM because the CAPEM normally discusses about only one model, right? Which is just a single factor. When you look at it, we normally analyze only one factor. Now, in this case, right, unlike a PEM, which is a single factor model, arbitrage pricing theory can be extended over multiple periods, right? It can be able to be factored over the multiple periods, which we talk about the multi-period time framework. Unlike a PEM that recognizes market portfolios, arbitrage pricing model does not recognize this portfolio since it's a proxy portfolio, right? So in this case, the arbitrage was developed not just to disagree. Let me just put that in order. It disagrees with whatever the CAPEM was able to put in place. And in that case, I will be able to analyze later, but let me just say this. This model, let me say this. This model was developed due to the limitations of capital asset pricing model. It normally assumes that there are several factors. Normally assume there are several factors which influences the return of the security. That is what the arbitrage pricing model assumes, right? And we say the model is based on the following assumptions. The model is based on, it is normally based on the following assumptions, right? Assumption number one, let me just write this for reference. Number one, the capital market is a perfect and efficient. The capital market is perfect and efficient. That is one. Number two, it basically discusses about the investors. Let me talk about the investors prefers more returns. These people will be able to prefer more returns. Then number three, we say returns of security. The returns of security is generated through, is normally generated through continuous buying and selling of securities. What can you watch here? Two is of that too. The other one you can be able to discuss later. But let me just leave up to that point. You can just be able to look at more through the research. Now, when you look on the Farmer French here, we say this model only normally considers three factors. It normally considers three factors. That is, market factors. Normally considers only three things: market factor, size factor, right? and size factor and value factor. Those are the only three things that the former French discusses and basically considers on its analysis. But now, when it comes to the pasta stumble, it says this model considers the three factors under former French, the former French, and liquidity factor. And liquidity factor. It normally considers the three factors under former French. So when you go to the former French, we are saying normally consider the market factor, size factor, and the value factor together with the liquidity factors. Those are the things that basically we need to check on. And if, for example, you are looking for more analysis and notes, I can be able to share with you. I can be able to scan a lot of notes here so that you can go and read right? And read there. So you'll be able to see most of the things there, but because we don't want to do all that, because we don't want to do that, to get the expected return, when you are factoring our models, right? It says, because now we are going to be, when you say, for example, under the arbitrage pricing model, it has said it was developed due to the limitations of the CAPM. CAPM only has only one factor, which we normally look at it. It normally has only one measure, which is a beta factor, only one. But in this case, it basically considers more risk premiums and so on. So we are going to be extending the formula for the CAPM, right? For example, we say, let us take the risk-free rate of return plus, here we are looking on the expected return of the market one minus the risk-free rate of return. You close these brackets by multiplying with the beta coefficient one plus, we are now opening another bracket. We say, can we be able to take the expected return of the market 2 minus the risk-free rate of return, then you multiply by beta coefficient 2, right? Plus now, the expected return of the market, 3, minus the risk-free rate of return. Then we have the beta coefficient, all that. Then tunaendanga sana. It normally have to factor more expected returns of the market. It analyzes different markets, and then it is going to be having more measure of the systematic or more measure of the risk. Remember when we are discussing about the CAPM, we said they normally measured using the beta coefficient, but now we are going to be having more beta coefficient to measure more risk, which are basically involved in our analysis or in the project that you're going to be doing. Now, this question is there. When you look on the November 2020, question 2B and question 3B there, respectively, it basically discusses about the analysis of the model. And then once I teach you about it, then you are going to be seeing the difference between the former French and the pasta stumble. So in this case, allow me just to go there to do that respective question. Basically, the examiner was trying to test you for the multi-factor models and then the aspects of the portfolio theory and analysis. So someone to read our question for us. So let me go there, please. Allow me to go there. Okay, so now we are discussing about 2020, when everyone was shocked by the emergence of COVID. So during this time, we had only one exam. We did only one. So we are trying to wait and open. Normally has a challenge here. So the paper itself, it seems to be so heavy. So allow it to open. So hakuna swali, and because I'm very perfect 100% that in the exam that you're going to be doing, you'll be coming across the portfolio theory. It is very important for you to base your argument or to be able to understand it well. Just be able to understand it well for to prepare for those exams which are coming there. So don't say I never told you. I never told you about advanced predictions. Unajua tunakaanga tukienda kufika kwa mtihani, students wanasema mwalimu huku tupea prediction. Mimi nishaanza. When you analyze those past papers of yours, you'll be able to realize that they have not been testing more of portfolio theory and analysis in our previous exam. So it is up to you. It is up to you. It's taking too long. Okay. It's taking too long, so let me see. It normally has problems in opening November 2020. Even you can check from your devices right now. 2020 always have a bit of challenge. It is a bit, it should be a very heavy file. Okay. I can see we have Carol here. Carol, trust you're doing well. And it is good you know some of you so that mnaweza fanya revisions, where you can be able to do the revisions. It's taking too long, but almost there. So the attendance is good, almost full. It seems you're enjoying the and I'm going to be specializing, by the way. I'm just going to be focusing on the most important topics before we engage on other topics. So once we finish this, we are going to be checking on the techniques of measuring risk. Sorry. The techniques of measuring risk, we will be able to analyze them next time because we cannot miss. If I'm not wrong, I was able to see the decision tree was brought in the exam. The decision tree was there. We will be able to see whether the simulation will be coming, whether the sensitivity and scenarios will be available in the exams. Those are very critical areas. Then we look on the most powerful model, which we normally use when we are measuring our risk, right? When we are measuring our risk in the investments, we normally use the net present values. The net present value. This paper is taking too long to open. So allow me nipige story kidogo. So when you are looking at it, the techniques of measuring risk are very, very important. Very important. I don't know how we are finding it hard to pass our exams, for example, at advanced level, because they are always on point. We don't have a lot of topics here, whether you are doing management accounting, whether you are doing taxation. I don't know how you are finding it hard, but I will be able to help you to come over to pass the papers. Where's the question now? It is question, it should be 2B. Yes, it should be question 2B. 2B. So I said someone will be reading for us. That person now I said is Caro. Caro can read for us, please. Can you read for us, Caro?
The estimated factor sensitivities of the Diamond Limited to former French factors and the Pasteur-Sternberg model factors and the risk premium associated with those factors are given in the table below. Factor sensitivity and risk premium. Market factor 1.05 for factor sensitivity, risk premium 5, size factor 0.65 for risk premium 2.5%, value factor 0.2 for factor sensitivity, 4.5 for risk premium, liquidity factor 0.2, and risk premium 4.5. The treasury bill rate is 5%. The required rate using the former French model, and the required rate of return using the Pasteur-Sternberg model.
So I can be able to see an examiner is trying to challenge Pale in an exam, whereby is has already given you the factor sensitivity. And the factor sensitivity in our case, we are discussing about the beta coefficient. And when you look on the risk premium I will be able to show you how we normally get our risk premium in the analysis of the CAPM. And in that case, it means the first requirement of the question the examiner is asking us, the required rate of using the former French model. And remember when we were looking at it in our notes, we said this model will always be factoring 3 factors. We'll be able to consider 3 factors. We talked about the market factor, as I can be able to see them on my left side. The market factors, the size factor, and then we have the value factors. So in this case, I will just be able to come here on my paper, here. Then the first thing that I will be able to do, I'm going to be writing my formula the way I have done mine here. I write my formula for analysis because I'm doing former French. It normally consider 3 factors. So in former French, this is what you have to do now, right? It will be able to factor the 3 factors. Now, when you take the expected return of the market minus the risk-free rate of return, this is what is basically called the risk premium, right? The difference between the expected return of the market minus the risk-free rate of return. This is what we discuss about the risk premium, right? Now, in that case, we now go back to the question and we look at, do we have these requirements? We say yes, right? We have these requirements. 1 minute. My machine might be switching off. Okay. That is okay now. Sorted. Very good. Now, when you look at it, let me get the expected return using the former French. We say, let us take the risk-free rate of return. Well, how much is our risk-free rate of return from the question? I would be able to see down there. They are saying the treasury bill rate is 5%. That is our risk-free rate of return. I take it is 5 minus the risk premium now. The risk premium, because they have already combined, wametoanisha wakakupea the answer. For example, for the market factor, it is around 5. I just say it is 5. We put it in the bracket. Then you take the beta coefficient, which is a factor sensitivity, which is 1.05 plus, right? Our second risk premium, we have been told it is 2.5. We just need to open the bracket to put 2.5 there. Then you multiply by the beta coefficient. The second one we have been told it is to multiply by negative 0.65, right? Plus the third one and the last one under the former French, we have been told it is 4.50. You close in the brackets. Then you take the factor sensitivity of it, which is negative 0.20. Very simple. You can just be able to put it in the calculator now, right? You'll be able to put it in the calculator. Then someone might be able to say, sijapata answer. Now, we'll be able to break it down in this manner. So how much is this? How much is this? How much is this? Correct. So it will be equal to 5 plus what? 5 times 1.05. You get 5.25. Right? This one now the signs will change. This is negative, this is positive. I just need to say 2.50. I multiply by 0.65. We get negative 1.63. Correct? Then minus also, because the positive and negatives, the negative is so powerful. 4.50 we multiply by 0.20. We are getting 0.9. So how much will be our answer? Now you can be able to take everything. We say 5 plus 5.25 minus 1.63 minus 0.9. We are getting something close to 7.72. 7.72. 7.72. 7.72 percent. That is how you normally use the farmer French model. If watakupea risk premium, wakwambia wamekupea factor sensitivity, umejua hiyo criteria yote now. Let us look on the pasta now. Pasta Stambo model. The pasta Stambo model, we have said, it normally factors the three, it normally considers the three factors under the former French, plus the liquidity factors. And because you cannot be able to repeat everything we have done here, you just need the shortcut. Unakuja hapo unaniambia mwalimu, tukitumia pasta Stambo na because niko na answer ya the former French, now nataka kupata pasta Stambo. This is what I do. I take 7.72 plus, you open the risk premium now of the liquidity. You say it is 4.50. We multiply by the beta coefficient with our factor sensitivity of 0.20. So how much is the answer? So I just say 4.50, we multiply by 0.20, right? Plus 7.72. 7.7,
Hi.
getting 8.62%. Someone amenisalimia. Kuna mtu amenisalimia somewhere. Kuna salamu.
Hi, can you hear me?
Yes.
I think you're too fast because we are trying to go back, check the Nini in another tab, then come back, then I think you're a bit too fast.
Okay. Niko hapo sasa, nimesimama hata. Nimehold hapo. Nataka nirudie wapi?
From hapo kwa farmer French. Itakuwa poa.
Hapa.
Yeah.
Now nimesema vizuri, examiner amekupea the risk premium, ameshatuanisha the areas of your brackets. Amekutuanishia, amekupea answers. So in this case, that is why you see I'm rushing. So you can see amekupea 5, 2.5. 5 is under the it is under the market factor, which is starting the first one is the market factor. So this is the factor. The risk premium has already provided by taking out this. Then our beta coefficient, the first one we said, is called the factor sensitivity. We come to the second one, 2.50. Multiply by our factor sensitivity for the size factor. Then the third one we said is 4.50. We multiply by that. I said, under the form of French, we normally factor 3 models. Sorry? Hapa tuna factor only 3. Market, size, and value. Market, size, and value. Analysis inaishia hapo.
Bado.
Nione nani ananisalimia. Karo sema. Karo iko sawa? Karo, is it okay?
Yes, it is okay. I'm sorry, my mic was on.
Oh, okay. Iko sawa mpaka hapo. That is what the examiner was trying to do there. So wewe kazi yako tu ni kumaster. Hapo unatumia market values, size, market size na value factors. Then hapo ukikuja kwa pasta Stambo, Unasema ina factor the former French models together with the liquidity. These are liquidity factors. Then that is the difference between the two. That is the difference between the two models, And you can see we have 6 marks. Uko karibu kupita. Ukiwa na 6 marks, you are almost passing your exams. You are almost passing the exams. Tuko na swali lingine up to that point. Because there is a question I just want to do. Tuko na swali lingine up to that point. Mtu aseme swali. Don't fear. Don't fear anything. So wewe ukitaka kwenda kufanya your practice, enda November 2019. Question number 3C. Enda pale ufanye your practice. November 2019 question 3C will be finding those kind of analysis there. But before we do the closure of our analysis tonight, it is very crucial for you to allow me to do November 2020, question number 3. It should be question number 3. Question number 3B. Should be around B there. Let me see here. Question, yes, it should be question number 3B. Question 3B. 3B. Sasa hapa lazima tutafute gender equality, wacha nione. Dorcas, Celestine, Emma. Hata ni kama ni warembo sasa. Let us stick with the gender. Now, I have not heard from Ino. I think I have spelled your name well. Ino, can you hear me?
Hi, yes.
Ah, good. Welcome to our online sessions.
Thank you.
Okay. Now, can we hear your voice by reading our question tonight?
That was November, which year?
November 2020 is just the question. I have not displayed it. It should be displaying in your screen.
Okay.
It's 2020 question 3B.
The shareholders of Mali Investment Holdings have for the last 2 years managed to save an accumulated fund of 15 million available for investment. A financial analyst they hired to appraise some possible projects they can invest in availed the following information. As you can see, project, initial cash outlay, expected return, standard deviation for project P, Q, R, and S, the covariances between various project contributions are as follows. For the project pairing and their covariance for PQ, PR, PS, QR, QS, and RS. Maybe you can go down a little bit. Additional information, the management is planning to invest by pairing the projects. The maximum capital that can be invested in the accumulated fund is shown above. Any paired project is mutually exclusive and none of the projects is divisible. Required. For each possible project pair combination, calculate the expected return, correlation coefficient, and standard deviation 12 marks, and advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance criterion 2 marks.
Thank you so much. Thank you so much. I always give this question assignment to students, but hakuna mmoja ashaitumia this question. So allow me to do it today. This question for pairing. When you look on the aspects of pairing two projects, I will just be able to tell you. This question guides you to the projects pairing which has a negative covariance, right? If it has a negative covariance, unaachana nayo, right? So if it has a negative covariance, we are not analyzing it. It's very simple. So when you're looking at it, and we are going to be looking on those pairings and trying to look on whether we can be able to to use our formulas to get any answer, any meaningful answer for the respective projects pairing. Now, let me start with the first one. Let me start with the first one. Right. Let me start with the first one, the first one. So let me start with the first pairing. I think you are having them there. So I have said, ignore the covariances or the projects pairing which are the negative covariances. So hapo nakuja, unaniambia wacha nichukue my portfolios or the projects pairing. So hapo unakuja unachukua project pairing, correct? With the positive now. So in this case, I will be able to start with PR. This PR, QR. Is it QR? Yes. It should be a PQ. PR, QR. QR does it? QR doesn't. So we have QS. The other one we have RS. I think they are like that. The others have negatives. So ushaeka swali yako namna hii. Zinakaa namna hiyo. Those are the projects which they don't have a negative. They don't have negative covariances. Unakuja hapa na kuambia vizuri, when you look at it, ask yourself, what is the portfolio is being required here for each project, the portfolios. Now, when I look at it, there is an initial cash outlay for each project. For example, the cash outlay is for these projects. We start with P. P requires 9. I'm just going to be writing I'm going to be rounding it off. Sitaweka thousands, yeah? I'll just be taking 9, right? To avoid mixing yourself. Then R requires how much? Unaniambia R requires an initial outlay of 6. So the total for these is around 15. It requires around 15 million. Now, when it comes to QR, Q requires 7,000. Kama ujui zinatoka wapi unaniambia. We have 7, and then your R is 6, getting a total of 13. 13 is 7 plus 6. Someone might be asking, na hizi vitu mwalimu anaandika zinatoka wapi? Then the other one is QS. Q is 7 and S is 8. This totals to 15. Totals to 15. Then the last project inataka pesa ngapi? Nakuja pale unaniambia R inataka 6. Then the other guy requires around how much? How much is S? S is 8. And these projects totals to around 14. Ushafanya namna hiyo, unakuja pale unaniambia, because you are being told that the management is planning to invest by pairing the projects, and then you are being told the maximum capital that can be invested is the accumulated fund, as shown above there. Then any paired project is mutually exclusive, and none of the projects is divisible. Divisible, it means, or the projects which are mutually exclusive, you can, the divisibility of it means that if you cannot meet the requirement of the initial outlay of a certain projects, then you can't take partial of it, right? We normally have divisible and indivisible projects. Those terms we'll be able to hear them when we are doing the advanced capital budgeting decisions. And let's go to the requirement number 1. For each possible project pairing combination, calculate the expected return, right? Examiner is asking you, can you be able to calculate the expected return? Then you're also being told the correlation coefficient and the standard deviation. So unaenda pale juu, unaangalia examiner amekupea nini. Already ashakupea the expected returns. Then it is very crucial for you to analyze the weights, right? So in this case, I'm going to be starting with the first one, right? The first combination. We say, can we be able to get the expected return of P and R? The P and R, the expected return of these portfolios of the two projects. We say, can I be able to take the weight of P? We multiply by the expected return of P plus weight of R, right? We multiply by the expected return of R. Correct. Where are we going to be getting the weights? Now, it is very simple. You can just be able to get the weights from these values that we have here. For example, when you look for the weight of P, I'm just going to be taking 9 over 15. That one can give me a weight. Then I go to the question I look at. What is the expected return of P? I say the expected return of P, it is 12. Plus the weight of W, or is it the weight of R? Yes, the weight of R is 6 over 15. Then we multiply by, what is the expected return of R? The expected return of R, you are being given how much? We are being given 16. And you'll be able to see where they are coming from. You can raise your hand, you can question about it. You know where they are coming from. You know where they are coming from. If you don't know, you can state. Do you know where they are coming from? If yes, it's okay. So in this case, unakuja hapo unaniambia, I'm just taking 9 divided by 15, I multiply by 12, plus 6 divided by 15, I multiply by 16. Maybe I'm getting something closer to 13.6. Hapa napata 13.6. Unless hujui inatoka wapi, you can just question. Nilisema kila mtu alikuja peke yake. Kama hujui imetoka wapi, just let me know. Now let us look at the second one. What is the expected return of the QR? Unakuja hapo unaniambia, to get the expected return of the QR, what am I taking? The weight of Q now. The weight of Q, I say, is 7 over 13, 7 over the total. Then I multiply by, I go to the question. What is the expected return of Q? Naenda pale naangalia napata ni 21. Plus, the expected return of R, or the weight of R, is 6 over 13. I multiply, what is the expected return of R? We say it is 16. Unaiweka direct kwa calculator. Uone utapata nini? 7 divided by 13 times 21. Plus 6 over 13 times 16. You are getting something closer to 18.69. 18 point something, closer to that. Eh? Now, to enter the next one, we are on the third one now. The expected return of QS. We say the expected return of the QS, we take the weight from the value that we have already generated here. It is 7 over 15. You multiply by, you go to the question now, and you look at how much for Q. We say Q, it is 21. Again, plus the other proportion now, it is 8 over 15. We multiply by, what is how much for S? We say, I go to check for the expected for S, which is 14. The expected return, how much it is? 7 divided by 15. We multiply by 21. Plus 8 divided by 15. We multiply by 14. We are getting 17.27. 17.27%. Then the last one, the expected return of RS. The expected return of RS. How much it is? We look on the weights from here. The first one will be 6 over 14. We multiply it by, what is the expected return of R? You tell me the R was 16, right? Plus the other proportion now, it is 8 over 14. We multiply it by what? 8 over 14, we multiply by, what is the expected return of S? You tell me it is 14. It is 14. Hapa mambo inakuwa rahisi. 6 divided by 14, we multiply by 16, plus 8. 8 divided by 14 times 14. We are getting something closer to 14.86. 14.86%. Unaweza kuwa ujui hizi figures zimetoka wapi. Unaweza kuwa ujui hizi figures where they coming from. Unaweza kuwa unajua hii figure ujui inatoka wapi. Unaweza kuwa unajua hizi figures zinatoka wapi. Give me just 1 minute, 1 minute, 1 minute. Thank you. Let us proceed. Thank you. That is the requirement. We are still under the requirement number 1, where we were being told to come up with the expected returns, right? The other thing they were asking is about the correlation coefficient. Number 2. Number 2, they ask you very simple things, right? Correlation coefficient. Nakwambia vizuri from our first question that we did, we said to get the correlation coefficient, for example, for the first pair, P and R, we are going to be taking the covariance of P and R. We divide by the standard deviation of P times the standard deviation of what? The standard deviation of R. Let me start with the first one, right? Let me start with the first one there. I can be able to see they have already given you the covariances down there because they have said the covariances between the various projects contribution as follows. So this is straight away. So to get the correlation coefficient of P and R, I'm going to be taking the covariance of both projects. So this is around 1.3. We divide it by, what is the standard deviation of P? 2.5. Times, what is the standard deviation of R? We are being told the standard deviation of R is 2.3. So how much are we getting there? How much is our answer? So it will be 2.5 times 2.3. Then I take 1.3 divided by answer, getting around 0.23. 0.23 here. Let's go to the second one. If you have not captured the formula, we say the correlation coefficient of the second pair, it is QR. So under the QR, unakuja pale unaniambia, let me look on the covariance of, for example, Q and R now. So the covariance of Q and R is 1.5. We divide it by, what is the standard deviation of P? The standard deviation of P, we have said, it is 2.5. It is P of Q, sorry. Q is around 1.8. Then for R is 2.3. For R is 2.3. So you just do your maths. We say it is 1.8. We multiply by 2.3. Then I take 1.5 divided by answer, getting 0.36. Correct. Let me go to the third pairing. I say, get the correlation coefficient for the third pair, Q and S. Now, the covariance of Q and S, it is 1.7. Right? We divide it by, what is the standard deviation? Not the standard, yes, the standard deviation of Q. Imepeanwa pale, which is 1.8. And for S is how much? For S is 1.6. 1.6. So hapa tunapata ngapi? We say 1.8 times 1.6, right? 1.7 divided by answer, getting 0.59. Then the last one would be the correlation coefficient of RS, right? For RS. Now, nakuja hapo nasema, for RS, the first one is 2.7. That is for the two projects pairing. Then when you look on the standard deviation for R, right, it is 2.3. And for the S, how much is for the S? 1.6, 1.6. Very simple. 2.3 times 1.6. Then we say 2.7 divided by my answer. We are getting 0.73. That is how you get it. It is very simple. That is how simple it is. That is how simple it is. Then the next one, they were asking you to compute the standard deviation of the portfolios. Now, the standard deviation of the portfolios, for example, I will be able to start with the first pair, P and R. Remember, we are using this formula, right? I will just be able to fix it here. Allow me to fix it there. So in this case, it will be the weight squared of P. We multiply it by the rate, the variance of P plus the the weight of R squared times the variance of R plus 2 weight of P, weight of R, then we multiply by covariance of P and R. Very simple. Let me start with this one. So it will be for P and R now. So the weight of P tulisema ni ngapi? Unakuja hapo unaangalia. The weight of P tulisema ni 9/15. Hata ndio hii hapa, 9/15. You say, I'm taking 9/15 squared. I multiply by, what is the variance? Unachukua the standard deviation. What is the standard deviation from the question? Unaenda pale kwa swali. Unakuja hapo unasema, examiner amekupea the standard deviation of P. The standard deviation of P is 2.5. You square it. Once you square it, you get the variance. Now let us go to the weight of R. The weight of R is 6/15 squared. I multiply it with, what is the variance of R? Unakuja hapo unaniambia the standard deviation of R now. The standard deviation of R is 2.3 squared. We add 2 times 9/15 times 6/15 times the covariance of the two projects. The covariance of the two pairing, where is it? The covariance of the first one is 1.3. The covariance is 1.3. That is how you do it. That is how you do it. So that is 1.3. So you put this data on your calculator. For example, 9 divided by 15 squared. I get 0.36. Multiply by 2.5 squared. And I 6.25 plus 6 divided by 15, right, squared. I multiply it by, allow just this to put this in this order, please. So let me finish up with the first one. 9 divided by 15 squared. I multiply it with 2.5 squared. Up and I put 2.25 plus 6 divided by 15 squared. I multiply it with 2.3 squared. Okay, 0.85 plus 2 times 9/15 times 6 divided by 15 times 1.3. We are getting 0.62. So in simple terms, 2.25, right, plus 0.85 plus 0.62, the root of it should be equal to around 1.93. So the answers of mine here should be equal to 1.93. I'm just doing that because of the space. That is 1.93. The other one will be, if you look at the standard deviation of the portfolio, now we are looking on the QR. Will be equal to the root of, we go now to the weights. It is a bit hectic because of the kind of the weights you are using. So in this case, it will be 7/13 squared. We multiply by, what is the variance? You go to the standard deviation here. Unakuja hapo kwa standard deviation unaniambia, we are looking for the Q. For the Q is 1.8 squared. Plus, the other one will be 6/13 squared. We multiply it by, right? What is the standard deviation of R? Unaniambia the standard deviation of R is 2.3. We add 2 times 7/13 times 6/13 times, what is the covariance of this? 1.5. 1.5 there. 1.5. So you get back to your calculator now. So the first one will be 7 divided by 13 we get that answer. Then we root it times 1.8 squared, getting 0.94 plus 6 divided by 13 squared. I multiply it with 2.3 squared, getting 1.13 plus 2 times 7 divided by 13 times 6 divided by 13 times 1.5. Get it 0.75. Right? So you take 0.94 plus 1.13 plus 0.75. We are getting 2.82. Once you root it, you root their answer, we are getting 1.68. Higher. 23rd one. The standard deviation of the portfolio for the QS. Okay, you do the same now. You take the rates, you take the weights, QS, it will be 7 over 15 squared times. You go now to the question, you say, can I be able to look at how much is the standard deviation of that? That's total to 1.8, right? 8 over 15 squared. I multiply it with, what is the standard deviation for S? We say it is 1.6. So 1.6 squared, right? Plus 2 times 7 over 15 times 6, sorry. 8 over 15 times. Now you look at the covariance of it, which is 1.7. Think you are able to see. So in this case, it will be 7 divided by 15 squared. Then I multiply by 1.8 squared. So here you're getting 0.71 plus 8 divided by 15 squared. Then you multiply by 1.6 squared, getting 0.73 plus 2 times 7 divided by 15 times 8 divided by 15 times 1.7 plus 0.73 plus 0.71. The root of the answer, you should be getting 1.51. 1.51. That is the standard deviation of the portfolio for the QS. Let me do for the last one. So the last one will be the last one for the RS. For the RS, let me do it here. For the RS, for the portfolio RS, we are going to be taking, right? We have 6 over 14 squared. I multiply it with what? I multiply with the, for the R is around 2.3 plus 8 over 14 squared. I multiply it with the, for the R is 2.3, right? S is the 1.6, right? Plus 2 times 6 over 14 times 8 over 14 times their covariance, right? Their covariance is 2.7. 2.7 there. So how much is this? You have 6 divided by 14 squared. I multiply by 2.3 squared. I get 0.97. 0.97 here. Plus, the other one will be 8 divided by 14 squared times 1.6 squared. Then we are getting 0.84. I know that you are following 2 times 6 divided by 14 times 8 divided by 14 times 2.7. We are getting 1.32. So plus 0.84 plus 0.97, the root of the answer should be equal to 1.77. That is how you do that question, 1.77. That is how you do it. 1.77. 1.77. Then there is a requirement number 2 of the question. The requirement number 2 of the question. The number 2 of the question, they're asking a very simple question there. They're asking you, advise the shareholders of money investment holdings on the optimal project pair based on the mean variance criteria. So when you look at it, you're going to be comparing here. And remember we said here, we have to be saying, right? The higher the risk, tuangalie from this point, the higher the risk, the higher the standard deviation. The higher the standard deviation and coefficient of variation. Coefficient of variation. So in this case, when you're looking at it, which one, because we want to minimize the risk, nobody who wants to invest with the projects with the highest risk. In that case, nakuja hapo naniambia, the optimal project pair, ukiangalia zote, the optimal project pair is QS. The optimal project pair is QS, right? Since it offers the lowest or the minimum risk. Since it is the one that is giving you the lowest risk. It is giving you the lowest risk. That is why we are factoring it. That is why we are saying our optimum pair is this one, because it is the one that is giving you the least risk out of the other three, other three combination. That being said and done, and thank you so much for staying with me. Tomorrow we shall be doing the last part of the portfolio theory. And I think that one will not be keeping us here for so long. I should be doing that part and introducing you to the advanced capital budgeting decision. So tomorrow we are going to be doing, we shall be doing portfolio theory. Sorry, portfolio performance measures. So tomorrow we shall be doing the portfolio performance measures. And once we do this, it can't keep here. It can't keep us waiting for an hour or something. This one we are going to be analyzing it. We are going to be analyzing in a very short time. Just be able to see whether I can put these notes in a word so that we don't have to write much of this. So let us see you tomorrow. Then from there, we shall see what we can do. I know that we were able to check on December 2022. There is a question I gave out there. December 2022, question 2B. I know that we were able to check on it, but I don't know. So feel free to ask your questions. Feel free to ask questions, please. Feel free. In the same group, I know that there are those who are doing taxation. You can reach out. We have our taxation on Friday. We have good analysis. We have advanced management accounting classes, which are running. So it is very crucial for you. Don't be left out, right? They are all, this is an optional. As for me, I normally see it is easier than the others, but if you consider the other options, it is okay. For those who have already selected taxation, you can inquire together with advanced management accounting. Thank you. So if we don't have questions, allow me to stop at that point. Allow me to stop at that point. Then I see you tomorrow. Is that okay?
Yes.
Okay.
Fine.
So see you tomorrow and allow me to wish you good night.
Good night.
Good night.
Good night.